everyone, welcome to SSM Sharda Educations. So now we are going to see about the current affairs related to Indian economy of the first week of July. So there are many interesting topics which will be useful for both prelims and mains, and we'll go into those topics. The first is computerization of primary agricultural credit societies. So whenever it comes to economy, the name itself gives us the complete concept. We are talking about society, we are talking about credit, we are talking about agriculture, we are talking about primary. So what does that mean? This is related to rural farmers and their loans. That's all. So primary agricultural credit societies are nothing but rural farmers and about their loans. Okay, so cabinet approves digitization of 63,000 primary agricultural credit societies. So this constitutes the lowest tier of three-tier short-term cooperative credit. This is about the cooperative credit in the country, which has almost 13 crore farmers. This is like very good introduction content. Okay, so the primary agricultural credit society alone has 13 crore farmers as its members, which is very, very important for the rural economy to grow. So it accounts for almost 41% of credit loans given by all entities in the country, and all of these KCC loans. It is 2.95 crore farmers through primary agricultural credit societies. Okay, fine. So the two other, this is nothing but Krishi credit card. Okay, Kisan credit card and Krishi credit card. So the other two tiers are state cooperative banks and district central cooperative banks. I told you about three tier. First being state cooperative, then comes the district cooperative, and then comes the primary credit society, agricultural society. This is the third tier. Okay. Yes. So this is very, very important. This can be a question. What are the three tiers of cooperative credit societies? First is state, and then comes district, and then comes what? Primary agricultural credit society. So district central bank, this is already automated by NABARD. So first two tiers being already automated by NABARD. Now the second, the third credit society is also digitized now. Okay. So after digitization, what happens is it comes under something called as common banking software. So this common banking software helps us in not just digitization, but also interlinking of data. So data can be retrieved from anywhere, and also operability from anywhere within the country is also helpful. So what are all the benefits? First and foremost is the computerization will bring transparency. So whatever credit is given or whatever credit is taken, what happens? It gets digitized, so it can be accessed from anywhere. So the transparency will include. And also these cooperative societies will get 4 lakh upgrade of their infrastructure. Okay, that is one important, their capacity, and even account holding records will be digitized so that they will have a very good technology. And then service delivery, like direct benefit transfer, interest subvention scheme, crop insurance scheme, Pradhan Mantri Fasal Bima Yojana, and inputs like fertilizers and seeds also will take place in a faster manner. So usually what happens, the files will keep moving on, and then it becomes later. But you can see these benefits being one of the important part of good governance, transparency, and then reduction in time delay, all these things, service delivery, proper service delivery, increase of capacity, everything are form of good governance. So obviously digitization will help in bringing up good governance. A government status said that this PACS account for 41% of crore farmers and Kisan credit loans given. Okay, so what happens in pipeline means what happens in the future. So amendments to the model bylaws that would govern this PACS will be placed in the public domain, because cooperative is a state subject. So this will come into public domain. Amendments to multi-state cooperative societies, Amendment Act of 2002 will also become in effect soon. Plans to set up a national cooperative university, very, very important. National Cooperative University, and pan-India legislation to govern credit societies. These are all like you can have it in way forward, helpful, very helpful in terms of means. You understand? Yes. Fine. Let's go to the next topic, external debt. So this nowadays UPSC has been asking many questions from this concept. Even in 2022, we got questions related to external debt. Okay, is government having more external debt or private? All these kind of questions arise every year. So let's see. India's external debt rose to 620.7 billion US dollars. Okay, it rose to 620.7 billion US dollars at the end of March 2022. So regarding increased case of 47.4 billion over 1 year of period. Okay, so this can be a question. External debt rose. So in general in economy, when there is a question like steadily increase, steadily decrease kind of questions are mostly wrong, because this year we got very high loan. Next year there is a high possibility that the loan has become lesser. At least 1 billion less loan is even possible. So we definitely cannot say that we are steadily increasing or we are steadily decreasing when it comes to economy. Keep this in mind. This will help in elimination method in terms of preliminary examination. So this data is given by Reserve Bank of India. The external debt to GDP ratio declined to 19.9% at the end of March 2022 from 21.2% a year earlier. Okay, so what is external debt? It means that money is borrowed from an outside country source. Okay, that source can be a governmental source or a private source. That doesn't matter. When money is borrowed out of our country, it is called as external debt. Keep that in mind. The territory here is the key. External debt has to be paid back in the currency in which it is borrowed. For example, that's why it is mentioned in US dollars. You can see. So, for example, the country is buying 100 billion US dollars. Then it has to be returned in dollars only, or it is buying in euro. It is getting in euro. Then it has to be given back in euro only. So that is what is the important point. External debt can be obtained from foreign commercial banks or international financial institutions like IMF, World Bank, ADB, etc., or from the government foreign nation. So anything is possible. It is not that we have to only get it from other country or private anything. Once you go out of the country, it becomes external debt. That's the topic. Okay. So normally it is in the form of tied loans. That is, they have to be used for predefined purpose. So we saw in terms of polity current affairs, if you see, we told that World Bank has been given $250 million of debt for road safety purpose. So here you see that it is predefined. This money has to be only used for this purpose. That is what you call it as tied loans. Okay, this is a very important concept. Tied loan is the loans given for some predefined purpose is called as tied loans. Yes. So sovereign debt is a central government's debt. It is debt used by national government in foreign currency in order to finance the issuing country's growth and development. So sovereign debt is one other type. So sovereign debt is a central government's debt. Okay. So it is a debt issued by the national government in foreign currency. Okay, fine. So impact, what is the impact? So in case of non-payment, sovereign default can occur, which can lead to lenders withholding future release of assets and might be needed by the borrowing nation. For example, we will be pledging something to get some, we'll be pledging some assets to get some loan. But if we are not repaying the loan, what happens? The assets will be held by the lenders. But now the country might be in need of that particular asset, but that will not be released by the lenders. This is a sovereign default. Okay, due to sovereign default, the borrower's currency can also collapse. Okay, so leading to the deterioration of economy's growth. The value of money will decrease. Next is, it can cause changes in the interest rate. Okay, to greater default by borrowers. So the interest rate will keep increasing and the borrowers will have more issues faced. Increased changes in the exchange rates of different foreign currency also can occur. Okay. So what is debt to GDP ratio? This is very important. This just now we saw that the debt to GDP ratio has reduced. The external debt has increased, debt to GDP ratio has decreased. So we'll see what happened. So debt to GDP ratio is a ratio between the government debt and its gross domestic product. You understand? So it measures the financial leverage of an economy. So how much GDP we have, in that GDP, how much we have, how much borrowed, and what is the GDP. So you're comparing it to understand what is the actual capacity of the country. The country able to continue paying interest on its debt without refinancing and without hampering economic growth is generally considered to be stable. But if this debt to GDP ratio is not stable, what happened? The country is also not stable. So a country with high debt to GDP ratio typically has trouble paying off with external debts. This is also called as public debts, which are balances owed to the outsiders. Okay, so debt to GDP, see, borrowing can increase. That is not an actual issue, but debt to GDP ratio should not increase. So if debt to GDP ratio increases, it means that the country is in trouble because the GDP is the same, but debt is keep on increasing, which means the country will not be able to pay the debt. That is what is called as debt to GDP ratio. Okay, so higher the debt to GDP ratio, the country is likely to fall economically. Fine. Okay, so we'll go to the next topic. Free fall of rupee. What is this free fall of rupee? We'll see. So the Indian rupee hit all-time low against the US dollars, which is weakening the past 79 rupees to a dollar mark, setting as low as 79.05. That is $1. 1 US dollar is equal to 79.05 rupees, which is the lowest. Okay, it took place on this month. So that is what is depreciation. So it's a floating exchange rate system. Currency depreciation is a fall of value of currency. So just for 1 US dollar, we have to pay 79.05 rupees, which means the value of US dollar is higher. The value of Indian rupee has decreased. That is what you call it as depreciation. The fall in the value of currency is called as depreciation. Depreciation of rupee means that rupee has lost the value against the dollar. Okay, so it indicates that rupee is weaker than it was earlier. So depreciation means value of Indian currency has fallen and it has become weaker. So what are the causes for fall of rupee? So FPI, foreign portfolio investment pull out. That is, the investors are taking back the money. That is one reason. Or the dollar is strengthening. Okay, nothing is happening on Indian side, but the dollar is strengthening. That is also possible. Rising crude oil prices. We know very well that recently there is a very high tension and war between Ukraine and Russia, so that there is a high demand in terms of crude oil. So rising crude prices. Deteriorating trade balance. So import-export balance. Import is higher and export is lower. Then it means that the trade balance is deteriorated. So what is the impact of depreciation? The impact of depreciation means that there is an inflation and we tend to pay more money to buy products. Okay, so rupees depreciation is double-edged sword for the Reserve Bank of India, because who has the hold of monetary policy? It is Reserve Bank of India. What are the positive? What is the double-edged sword? So two sides are there. One is positive, one is negative. So depreciation is not bad alone. It's good and bad, but only when it is controlled. Let's see. Exports may benefit from a weaker currency because when the value of rupee falls, the Indian products become cheaper. So cheaper the products, the demand is higher in terms of world market. But what is the negative? It increases the risk of imported inflation and makes it more difficult for the central bank to keep interest rates at record low for an extended period of time. So imports will become costlier. Exports will become cheaper. Obviously, the demand will increase, but imports will become costlier, so inflation might arise. That is the problem when it comes to this free fall of rupee. Next is Financial Services Institution Bureau. What is this? The central bank has transformed the Banks Board Bureau into Financial Services Institution Bureau by making some amendments. See, this Bank Board Bureau is a very important question because twice it has come in UPSC. First is who appoints the chairman of commercial banks? That was a question. So these kind of questions come again and again about the Banks Board Bureau. So this time, this also has a current affairs, that is Financial Services Institution Bureau is nothing but it was previously called as Banks Board Bureau, and the Reserve Bank, the Financial Services Institution Bureau has been changed from Banks Board Bureau with some amendments. What are those and who transferred? Nothing but the central government has transferred, transformed it. So about Financial Services Institution Bureau. The Financial Services Institution Bureau will make recommendations for appointments of full-time directors and the non-executive chairman of banks, financial institutions. So this was the UPSC question in year 2020. Fine. This year also there was a question related to this Banks Board Bureau. Guidelines to select general managers and directors of public sector. General insurance company is also part of FSIB now. So initially they only took care of banks. Now general insurance companies are also coming under them. That's why instead of Banks Board Bureau, they have changed it to Financial Services Institution Bureau. Now do you understand the change? Initially they were only taking care of banks, but now they are taking care of any financial services institution. So what is about the chairman and members of Financial Services Institution Bureau is the ACC has approved the appointment of Banu Pratap Sharma as initial chairperson of FSIB, and he has been appointed for 2 years. He was a former chairman of BBB. Okay. So other members of FSIB include Aminesh Chauhan. He was the former chairman and managing director of erstwhile Oriental Bank of Commerce. So now he has become one of the members. Deepak Singhal. So he was the RBI's executive director. Now he is also a member. Sailendra Bandhari. He was former MD of erstwhile ING Vaisya Bank, and now he is one of the member of this Financial Services Institution Bureau. Next is small saving instruments. So what is this small saving instruments? The government said that it has decided to keep interest rates on small saving instruments unchanged for July to September quarter. So every year in financially, every year is divided into 4 quarters, 3 months, 3 months, 3 months each. So now the government has said that from July to September, the interest rates of small saving instruments will not be changed. So what is the details? Schemes like Public Provident Fund, National Savings Certificate will continue to carry an annual interest rate of 7.1% and 6.8% respectively. So the 1-year term deposit scheme will continue to earn 5.5% interest. Term deposits of 1 to 5 years will fetch a range of 5.5 to 6.7% to be paid quarterly. Every 3 months it will be paid. While 5-year recurring deposits has a higher interest rate of 5.8%. So small saving rates are linked to the yields on benchmark government bonds. So what is the small saving rates linked to? So the fluctuation in small saving rates is dependent upon what? This will definitely be a question. At least the numbers you have to know the range. It is around 6, 7, 5%, 7%, 6%. So this is the range. But what does that fluctuation come from is based on the government bonds. Okay, that is the reason. Despite the upward movement in GSEC yields, government sector yields, that is nothing but GSEC is government sector yields, the government has not increased the interest rate. Now the government is doing good, but still they have not increased. So about small saving schemes. See, these are the set of saving instruments by the central government. Okay, what is this? Is saving schemes of central government to encourage savings. That is the reason. The central government scheme to encourage savings, save regularly. So high returns, they are very popular because they do not only provide returns that are generally higher than the bank's fixed deposit, but also has tax benefits and sovereign guarantee. The government itself is guaranteeing and they are having tax benefits. That is the one important plus. Not just the interest rates are high, but also sovereign guarantee and tax benefits are there. So it can be grouped under 3 heads: post office deposits, saving certificates, and social security schemes. These are the 3 important small saving instruments. Public Provident Fund and National Saving Certificates will continue to carry the 7.1 to 6.8% respectively. Okay, next. What is retail inflation? So what are the issues related to this is retail inflation. Considering that the retail inflation hit 7.97%, the existing rates are lesser. Okay, so even though it is higher than the bank's rate, when the inflation rate is higher, it is like comparatively less. That will bring a loss. Negative real returns, except Public Provident Fund and Sukanya Samriddhi Yojana, all other small saving instruments are currently fetching negative real returns and high inflation. That is one issue. Okay, so the returns are negative, real returns are negative. Okay, small saving rates linked to yields on benchmark government bonds. So the government has not increased. That is also one issue. We trust the government to increase, but they have not increased. Depositors are losing money because of inflation. Now it is over 7%. The 1 year bank fixed the deposit rate around 5.3%. You can just see 7% and 5.3%, which means whatever we deposited, from that itself the value of money is decreased. Okay, so we are losing money and we are lacking proper social security system. So the real rates discourage savings than encouraging the saving. So what we think, instead of just saving it and losing money, we'll just go buy something. That is what we will think, right? Just why do we want to give the money to government? That is what people will think. So instead of encouraging, it is even boosting more consumption. So boosting more consumption will eventually lead to more inflation. What is inflation? Circulation of money. Flow of money will increase purchasing capacity of people. Purchasing capacity will increase demand. Demand will increase inflation. This is how it works. So once we are making the people to save, the flow of money reduces so that the inflation will eventually reduce. But instead of doing that, what happens is it is discouraging the people to save and people tend to use more money. So it will eventually increase the inflation. Next is Mayurbhanj superfood ant chutney. What is this ant chutney? Let's see, it's very interesting. See, the kai chutney made from red ants. Okay, red ants by the tribal of Mayurbhanj district in Odisha is seeking a geographical indication tag. Okay, so what is this? What is GI tag? Very important question. Every year you can expect at least one question from GI tag. So it is a sign used on products that have a specific geographical origin and possess qualities or a reputation that are due to the origin. So I'll give you one example. There is something called as Tirunelveli halwa. So Tirunelveli halwa is very famous because it is believed that there is a river called as Tamarabarani, that halwa is made using that water. So it is believed that the halwa is tastier because of that water. This is what you call it as geographical origin, and that unique feature is also because of that geographical origin. That is when you get geographical indication. Do you understand now what is about this Tirunelveli halwa? The Tirunelveli halwa is getting the taste from the Tamarabarani river. So the taste is because of the geographical feature, and it is also originated in that particular place. That is why it is recommended for geographical indication. Let's see. So who is the nodal agency? Is Department of Promotion of Industry and Internal Trade, Ministry of Commerce and Industry. So India is a member of World Trade Organization and has enacted this geographical indication of goods and services Registration Protection Act of 1999. Okay, with effect from September 2003. So GIs have been defined under Article 22, Clause 1 of World Trade Organization's agreement called as trade-related aspects of intellectual property rights. This was also one of the UPSC question. This TRIPS. Geographical indication is related to which are the following TRIPS. The tag is valid for 10 years. This is also very important. So now let's go to ant chutney. What is this ant chutney? What is its speciality? See, despite this, weaver ants are popular among the people, most of the tribes. The food item is rich in protein, calcium, zinc, vitamin B12, iron, magnesium, potassium, sodium, copper, fiber, and 18 amino acid, and it is known to boost the immune system and keep disease at bay. So it is having a very good medicinal property. See, this vitamin B12 is very unique, very important. Why is vitamin B12 is only obtained from natural sources. It cannot be synthetically produced. So from natural sources also, where it is obtained is from egg, and then from milk, and then from red meat and some fishes. So this is how vitamin B12 is obtained. So this is one thing, because many people are lacking vitamin B12 because of changing in food habits. So vitamin B12 can only be injected. It can be consumed through tablets in a very short uh, you know um, dosages. But if you have to have a good dosage, it is only injected. So that is the very important concept about vitamin B12. So applied under food category, the GI tag will help develop a structured hygiene protocol in the preparation of this Kai chutney for standard wider use. So geographical indication label enhance the reputation and value of local products and support local business. That is the important thing about this GI tag. Why this GI tag is obtained is, sometimes it has a geographical origin and a important geographical feature, but the other people from different other geographical location start to preparing it and selling it, so the local business will fall down. But this geographical indication will give them a label of authentication that that geographical product will have more value in the market. That is this geographical indication. It is like a value addition, okay, and recognition for original products. Next is changes in Foreign Contribution Regulation Act. What is this Foreign Contribution Regulation Act? Is that Indians can receive up to 10 lakh a year from a relative staying abroad without informing the authorities. The earlier limit was 1 lakh, but now the Union Home Ministry has amended that under Foreign Contribution Regulation Act, an Indian can obtain about 10 lakh from a relative staying abroad without the permission from the authorities. Above 10 lakh, every year they have to be giving an information with proper tax paying all these regulations. So what has changed? Political parties, judges, government employees who are prohibited from accepting foreign contribution will no longer be prosecuted if they receive foreign contribution from the relatives abroad and fail to notify the government within 90 days. See, what happens is, political parties, judges, government employees and media houses, they cannot accept foreign contribution, okay, but now they will not be prosecuted unless they are informing the government within 90 days. So the foreign contribution regulation amendment rules was recently notified by Ministry of Home Affairs. See, this is very interesting. Foreign contribution amendment rules looks like a financial topic, or sometimes it seems like a foreign affairs, but who's controlling it is Ministry of Home Affairs. That is something very important. According to FCRR 2011, any person who receives a foreign contribution in excess of 1 lakh rupee or equivalent in a fiscal year from any of his relatives must notify the government within 30 days of receiving. The amendment rules now has changed to 10 lakh in a year, and earlier limit was 1 lakh. The amount exceeds, the individual will have 90 days to inform the government. Initially, as I told you, it was 30 days. Though two things have changed. So the limit has increased and also the time limit also has increased from 1 lakh to 10 lakh, from 30 days to 90 days. Okay. So what is the plus is that sometimes instead of removing the rules, relaxation of rules will make many people follow the rule. Do you understand what I am meaning? Instead of just having a very strict rule, or instead of having no rule at all, having a balanced and relaxed rule will have more people to follow. Similarly, the amended rules have given individuals and organizations and NGOs 45 days. So individual is 90 days, NGOs and organizations 45 days to inform ministry about bank accounts that are used for utilization of fund. So initially it was 30 days. Anyone receiving foreign funds under this will now be required to comply with existing provision for the submitting audited statements of accounts. As a result, provision requiring an NGO or individual receiving foreign funds should declare such contribution in the official website every quarter has been repealed. Okay, yes. So what is this Foreign Contribution Regulation Act? See, this regulates foreign donations and ensures that contribution do not adversely affect internal security. Especially this is related to terror financing or terrorism financing. So this is the main thing. So receiving foreign contribution is not an issue. But what if that caused the internal security? That is the issue. First enacted in 1976, it was amended in 2010, and now it is amended in 2022. So it is applicable to all association groups, NGOs which intend to receive foreign donations, mandatory for all such NGOs to register themselves under FCRA. So it is valid for 5 years and it can be renewed subsequently if they comply with all norms. So initially 5 years, then it can be renewed. Okay. So this can be a prelims question. What is this FCRA related to? Can be a question. Next is trade deficit. What is a trade deficit? India's trade deficit is simply import is higher than export. That's all. Simple. That is trade deficit. India's merchandise trade deficit has hit a fresh high of 25.63 billion in June as imports surged to 51% to 63.6 billion, significantly outpacing 60.8% rise. See, export also have increased, but just 16.8%. But imports increased to 51%. That is the issue. Okay. Yes, the previous trade gap was 24.3 billion. Now it is 25.63 billion. So what is the trade deficit? Simply means the balance of the country. The difference, as I told you, export minus import. So import is higher and export is lesser. So this will come in negative. That is called as trade deficit. Okay. So the number is negative. That is, total value of goods imported is more than the total value of goods exported. So India has a trade deficit with China, then China would necessarily will have a trade surplus with India. So one more thing is, this surplus deficit is also dependent on country. In general, we will have a trade deficit. Country to country also we might have a trade deficit and surplus. For some countries we export, some countries we import. So it depends. What is the current account deficit? It is very, very important. This is also every year question is asked. What is current account deficit is? It's the shortfall between the money flowing in on exports and the money flowing out on imports. Okay. So it measures the gap between the money received into and sent out of the country on the trade of goods and services, and also the transfer of money from domestically owned factors of production abroad. So what is it in general is, current account is used for foreign trade. Current account deficit is, we are receiving money through exports. We are sending money out through imports. So difference between them, when the money given for imports is higher, it is called as current account deficit. That's all. That's very simple. So it is slightly different from the balance of trade, because in balance of trade we only measure about import and export. But here in current account deficit we also include one more thing, which is domestically owned factors of production. That also is included. So in general you keep current account deficit as a trade account. Okay. I'm having a shop. Let's consider I have a shop. So what I do, I sell people, I get I get stock, and I'm also producing something. Okay. Now what happened? Combined all these things, I have a money separately only for the shop. I have a personal account separately. I have money only. I have an account only for the shop. All the shop affairs, export, import, factors of production, everything. So this is called as current account. So in general, doing all the activities, when you see the money is less, the money is deficit, it is called as current account deficit. Now do you understand? So that is why it is slightly different from balance of trade, because balance of trade only speaks about exports and imports. But current account deficits, it is also talking about the transfer of money from domestically owned factors of production also. Okay. Whereas the current account also factors in the payments from domestic capital. For example, rental income from an Indian owning a house in the UK would be computed into current account, but not in the balance of trade. Okay. Next is reasons of surge in trade deficit and current account deficit is mainly because of oil prices amid the pickup in the domestic demand will significantly enhance the India's import bill. So oil prices have increased, but there is no reduction in demand in the India's domestic market. So that is why the demand is higher, the import also, the bill is also higher. Anticipation that gold imports will remain high as the investors look to the hedge against the market volatility and inflation. This especially aggravated due to Russia-Ukraine conflict. Four of India's top 10 export items saw contraction. What happened? Engineered goods, and then slid drugs and pharmaceuticals, cotton, yarn and handloom products, plastic and linoleum products, all these have reduced. This is the four top products, export products, but that has also fallen. So these are the issues related to current account deficit and trade deficit. Foreign portfolio investors exiting the Indian market. So we just saw the fall of Indian rupee is due to the foreign portfolio investors pulling the money out of the market. So what happened? So FPIs have been selling spree in India in June 2022 to witness the worst sell-off since March 2020 when India announced a nationwide lockdown at about 50,000 crores. So this is very bad. Let's see what. See, what are foreign portfolio investors? See, the foreign direct investors is they come directly invest in some company. Foreign portfolio investors is they invest in the market, money market, funds in the market outside their home. That is called as foreign portfolio investors. So it is typically nothing but equities, bonds and mutual funds. They are not active shareholders and do not have any control. Foreign direct investment will have control, but they do not have control. They only have shares. They hold shares. That's all. So the passive nature of investment also allows them to enter or exit a stock at will and with ease. They can enter anytime, just like we purchasing stocks. Okay, they are purchasing from foreign. That's what you have to keep it in mind. So I'm having stock of Tata Motors, let's say. But I don't have any say in terms of Tata Motors decision making. So I can buy or sell anytime I want. That is what is same as foreign portfolio investors. So what factors per FPI moves? Promise of attractive returns on the back of economic growth draws investors including FPIs in a country's market. It also shows keenness to invest in bonds where there is a favorable differential between real interest rate on offer in the country and other markets, but more specifically compared with the largest economy in the US. Because what happened simply, foreign investors are going in search of better markets. Why have FPI been selling in India is post-pandemic recovery issue. Okay, return of pent-up demand in economies worldwide as pandemic subsidized. There is a high demand in other economies also. So what happened? The recovery caught suppliers off guard, contributing to supply side shortages. So they thought the demand has reduced and they did not produce properly. That is also one issue. Even an industry was grappling with this challenge in Russia. So Russia launched an attack on Ukraine. Sunflower oil and wheat supplies, for example, of these two nations has impacted to the rise in global prices. Wheat and crude oil prices have increased globally. So in general, tightened across the globe, commodity price too rose and overinflation accelerated. Okay. So whenever inflation takes place, the value of that country's money will reduce and the returns will also reduce eventually. So what happened? The investors will take their money outside instead of facing loss and they go to the better economy. That is what is happening here also. The pandemic is causing inflation in our country. So we are having more deficits also. So we are not performing economically better. So people are moving outside our country's investment. Okay. Yes. So US Federal Reserve is raising the benchmark interest rate from this year. Okay. The key rate went up almost 0.25% in March to 0.751% in May. So this is expecting to raise about 50 basis points at Fed meetings. See, nowadays UPSC is asking at least one question related to stock markets. That is very important. What impact does this FPI sell-off have? This will, just we saw, it will lead to fall of rupee. Okay. So So after they sell rupees in exchange for their home market currency, the supply of rupee in the market rises, so the value decreases. That is, demand for rupee will decrease, so the value of rupee is also decreasing. With weaker the rupee, we have to shell out more funds to import some unit of goods. So this will contribute to that is how we can have 85% of our oil needs through imports. Okay, this will also affect our trade balance. That is what they are mentioning. Two things it will do. One, it will increase the inflation by the fall of rupee value. Second is high import bill because we need more goods. Okay. Next is minimum support price. What is this minimum support price? Ahead of nationwide protest by Samyukt Kishan Morcha demanding law to ensure minimum support price, the Niti Aayog member Ramesh Chand said here on Wednesday that MSP should continue till markets become competitive and efficient. Okay, so what happens is Samyukt Kishan Morcha, they are demanding law to ensure minimum support price. So a person from Niti Aayog, member from Niti Aayog, Ramesh Chand is also saying that minimum support price should continue till the market is more competitive. So minimum support price is the minimum price set by the government for certain agricultural products at which the products will be directly bought from the farmers. The open market price are less than the cost incurred. So what happened? I am having turmeric, let's say. I am having a turmeric farm. So the government's minimum support price is 30 rupees per kg. These are like I am saying, let's say. So what happens? The market price is 50 rupees. So a farmer is welcome to sell it for the 50 rupees in the external market. But if the 30 rupees minimum support price is there, but the market is 10 rupees, what happens is the government will directly buy the turmeric from the farmer for 30 rupees. So what happens? 30 rupees, this minimum support price is fixed by the government based on certain factors to ensure the farmers do not face loss. Okay, so that is what is minimum support price. So provide a floor for market prices, ensure that farmers receive a certain minimum remuneration, so their cost of cultivation with some profit can be recovered. Who announces it? Very important. It is announced at the beginning of sowing season for certain crops by Commission for Agricultural Cost and Prices. Very, very important. And Cabinet Committee on Economic Affairs chaired. So announced at the beginning of sowing season for certain crops on the recommendation of Commission for Agricultural Cost and Prices, but who is announcing it is Cabinet Committee on Economic Affairs, not agriculture, economic affairs. Okay, so very, very important. This was once asked in UPSC. Crops covered by MSP include, this is very important. What are all the crops? This also can be a UPSC question. 7 types of cereals, namely paddy, wheat, maize, bajra, jowar, ragi and barley. This is just cereals. Next comes 5 types of pulses, channa dal, tur dal or arhar dal, urad dal, moong dal and masoor dal. 7 oil seeds, rapeseed or mustard, groundnut, soybean, sunflower, sesame, safflower and Niger seed. And 4 commercial crops include cotton, sugarcane, copra and raw jute. Copra is nothing but coconut. Copra and raw jute. Okay, very, very, very important. This can be a question. Fine. What is the rationale behind the demand for this MSP? See, farmers receive less MSP in most crops grown across much of India. The prices received by farmers, especially during the harvest time, well below the official declared MSP. So what happens is that MSP will give them a statutory backing. It will give them a assurance, guarantee that what they are sowing will not become a loss. That is the first and foremost thing. It's a statutory guarantee. So limited procurement government, also the actual procurement, limited procurement by government. Also the actual procurement at MSP by the government is confined only to about the third of wheat and rice crops, which is bought in Punjab and Haryana alone. So 10 to 20% of selected pulses and oilseeds according to the Shantakumar committee report. Okay. So now only 6% of farm households sell wheat and rice to the government at the MSP rates. So it is not that everybody will sell it to the government, but whoever is in loss can sell it to the government. What are the challenges with legislation? Okay, what is legislation possible, or what are all the challenges with related to legislation? We'll see. See, statutory MSP is unsustainable. What happens is, a policy paper by Niti Aayog argue against legalizing MSP that any fixed predetermined price will push away private traders. Okay, so what happens, even when the production is more than the demand, the private players will move away in thinking that they will not give it to them, they will only give it to the government. So they don't come for competition. This will lead to government de facto becoming the primary buyer of most farm produce, which is unsustainable. Okay, so it will become monopoly, government monopoly instead of private parties. This will kill the competition. That is one issue. Huge scope for corruption and recycling leakage of wheat and rice from goodowns, ration shops also will take place. Okay, so they will take from godown and government godown itself and they'll sell it to the government itself. It's like corruption and recycling will take place. Disposable problems. Okay, government is purchasing and they are giving to public distribution system. But what if they are purchasing more? They don't have a proper disposal mechanism. They don't have a proper storage mechanism. That is an issue. Sometimes inflation will take place. Higher procurement cost will increase in the price of food grains, leading to inflation. Because the private company will tend to compete with the government, so the price of product will increase. So increase in the price of product will lead to inflation. That is also one issue. Okay. Next is, it will also impact India's farm exports. So if MSP is higher than the prevailing rates in the international market, people will tend to give it to the government instead of exporting it. So it will also lead to trade deficit. Okay, because farm exports account to 11% of total exports of commodities. The legally guaranteed higher MSP, India faced stiff oppositioners at World Trade Organization. The same issue. For this issue only, India is facing, because when the country is promising a minimum support price, which means that if any foreign country has to import the product, it should definitely set the price above the government's MSP. Only they can buy it. Otherwise, the farmers will tend to give it to the government instead of exporting it. So many countries went to World Trade Organization and they stood against this differential treatment. So that was an opposition in the World Trade Organization, asking to scrap off the minimum support price. That is one issue. What is the price deficiency payment system? Under this, the farmers will be compensated for the difference. Instead of giving the minimum support price, they will be compensated for the difference. Such as rice, wheat, where MSP is effective now, the same will continue. For other targeted crops, price deficiency payment will be soon introduced. Okay, instead of promising some money, whatever the difference is, the government will give. Okay. However, notably, there may be a cap on extent to which the center will bridge the gap between MSP and market price. Farmer would have to register in the APMC Mandi. Okay, agricultural produce and market Mandi, report the total area to avail this benefit. It will be paid through direct benefit transfer. Okay, through Aadhaar and bank. Insurance Regulatory and Development Authority of India. The Insurance Regulatory and Development Authority of India has permitted general insurers to introduce technology-enabled add-ons to motor-owned damage insurance cover. Okay, so what happens is, the Insurance Regulatory and Development Authority has agreed to permit the general insurance to insure technology-enabled add-on to motor-owned damage. So what is this IRDAI? It's a regulatory body, comes under the jurisdiction of Ministry of Finance. This is very important. Regulatory body, Ministry of Finance. What are its work is? Regulating and promoting insurance and reinsurance industries in India. Constituted by Insurance Regulatory Development Act, which means it's a statutory regulatory body. Okay, its headquarters is in Hyderabad, Telangana. Now it is moved to Delhi. It is moved from Delhi in 2001. So, sorry, Initially it was in Delhi, now it is in Hyderabad. Okay, next. Composition of IRDA. As per section 4 of IRDAI Act, it has a chairman, 5 whole-time members and 4 part-time members. I am repeating, a chairman, 5 whole-time members and 4 part-time members. Life insurance companies, both public and private, will come under this authority. General insurance companies, both public and private, among them there are some standalone health insurance companies that offer health insurance policy. Reinsurance company and agency channels also come under this Insurance Regulatory Authority of India. Okay, intermediaries, which include corporate agents, brokers, third-party administrators, surveyors and loss assessors, they also come under this. Fine. Next. So these are the composition of IRDAI. So what is the function? The function is defined in section 14. According to that, issuing, renewing, modifying, withdrawing, suspending or cancelling registration. Issuing, renewing, modifying, withdrawing, suspending or cancelling registration. They have these powers, and they protect the policyholder's interest. And then specifying qualification, code of conduct for both the surveyors, loss assessors, intermediaries and agents, giving them training, and then promoting efficiency in the conduct of insurance business, and then regulating the professional organization. They are regulating everything. They give the rules and set of rules and regulation. And if there is any problem, they levy the fees and other charges. Okay, they inspect and they investigate the insurers. If there is any discrepancies, are the policy holders treated properly, are their interests protected, all are their functions. They also regulate the rates, advantage terms and conditions which may be offered by insurers, which are not covered by the Tariff Advisory Committee under section 64U of Insurance Act of 1938. Okay. They also specify how books should be kept. Books is nothing but the accounts, regulating company investment of funds and regulating margin of solvency. So what is this margin of solvency is? If the insurer is not able to pay the premium, what will happen? All these things are decided by this regulatory authority. Next comes the financial stability report. This is the last topic of economy. Financial stability report. Okay. From the name itself, you should understand who will release this. Obviously, Reserve Bank of India will release, because they are the responsible one for financial stability. Okay, the release which said that bank NPA ratio are at 6-year low. Okay, non-performing asset ratio are at 6-year low. Major finding of the report: the net non-performing, what is this non-performing asset, is for 90 days. If the loan is not paid back, the interest is not paid, it is becoming another concept of NPA. Ratio fell by 17 BPS during 2021 to 22 and stood at 1.7% at year end. So what you have to know is, when coming to economy, one big issue, there are so many numbers. Is there a need to remember all those numbers? No. But you have to know whether it is falling or increasing, and you also should know about the range of the numbers. At least not the proper number, but you have to know the range of the number. Okay. Gross non-performing asset ratio is that the asset quality of banking system has improved. So the non-performing asset has decreased, which means the banks are doing well. Okay. So non-performing asset, gross national non-performing asset ratio is declining from 7.4% to 6-year low of 5.9%. So bank has reduced the ratio through recoveries, write-offs and reduction in slippages. How this happened is, they have done some recoveries, write-offs and reduction in slippages. The provisioning coverage ratio improved to 70.9% from 67.6% a year ago. Simply you have to understand we are doing good, and financial stability report is released by the Reserve Bank of India. Okay, so write-off ratio fell off and to 20.0%. Okay, so next, regulators and supervisors face a challenging balancing act between the innovation friendliness and managing risk to financial stability. As the financial system gets increasingly digitized, cyber risks are also growing. It's very important. Everything you're talking about digitization. Even now we spoke about digitization of credit societies. Now we are doing every online transaction. We keep money in bank. So digitization is also making us more vulnerable through internet. So that also should be considered. About financial stability report, it is published by RBI biannually, okay, on the behalf of Financial Stability and Development Council, an umbrella group of regulator, which gives us the overview about the health of Indian economy, Indian financial system. It reflects the collective assessment of who? Subcommittee of Financial Stability and Development Council on risk to financial stability. Okay, so the RBI looks at the state of both global as well as domestic economy, not just the domestic economy. They talk about both the global and domestic economy. It focuses on public and private banks with following aspects. This is very important. What? First is capital availability for working. Are they having the, what is the, why the capital is needed? To give loans. They need money to give loans. Capital availability for working, cost of NPAs and whether they are manageable, credit flow in different sectors in the economy, credit flow at personal levels, households, different sectors, all the primary, tertiary, secondary, tertiary sector and household. So how the credit flow is happening? Is the money going outside? Loans are given properly or not? Loans are received back, collected back properly or not? All these things are checked. Macro financial risk in the economy. What are those macro financial risks? Stress tests are also performed by RBI as a part of financial stability report. Stress test is how much the economy can handle, how much stress the economy can handle. Are we having a backup? All these are stress test. Okay. So yes, this is all about the economy. We have seen many important topics. Some topics which have also been asked in UPSC were also discussed today. So thank you so much. You can get all this material from the SSM Sharda Education's website, and we'll see in upcoming classes. Thank you so much.